Alright, so this is our third lecture. It's on financial markets and institutions. We'll talk about the difference between markets and institutions. We'll compare and contrast them. But first, let's start by just asking, why do financial markets and institutions exist? They exist in order to help money transfer through the economy. One way to think of it is they exist so that money can get from those who have too much to those who don't have enough. There's certain people we call lenders or savers who have more money than they can spend at a given point in time. There's other people who have projects they want to take, or they want to buy a home, or they want to go to college, or things like that, but they don't have enough money to do it. And so financial markets and institutions transfer that money so that more economic activity can happen and the economy grows and we're all better off. You can imagine what life would be like if we didn't have a financial system in place to allow that transfer to happen. There's a thing called the financial life cycle, which refers to the fact that when you're young and you're building a family and you just got out of school, you have a lot of things you need to spend money on. You need to buy a home, you need to provide for your wife and children and so forth, things like that. But you haven't worked at all to save any money up. You're young. That's when you just get out of school that you're doing all that stuff. On the flip side, when you're retired and you're elderly and you've been working for 30 years, you have a whole lot of money, but you probably don't have a whole lot to spend that money on. Your kids have moved out, you've lived your life, you already have a home and all that money, and at that point you have a bunch of money, nothing to spend it on. It'd be nice if you could borrow against that future money when you're young, spend it then, and then you don't need it when you're older, and that's what finance life cycle helps happen. It helps that transfer happen. So you can borrow against your future wealth today to buy a home, to go to school, to start a business. Businesses need capital to start, but when they're starting, they haven't earned any profits yet. So you can't use the profits of the business to start the business if there was no financial system in place. But with the financial system in place, you can borrow against the future profits of the firm to start it today. That's what the financial system helps happen. There's two types of finance, what's called direct finance and indirect finance. Direct finance is when there's a direct face-to-face interaction. It doesn't have to be face-to-face, but there's a direct transfer from the lender to the borrower. Indirect finance is much more common, which is there's a middleman involved. So there's some middleman out there that takes and pools the money from all of the lenders or savers and then transfers it to the borrowers. Here's a little chart just to show that process. Nothing fancy, but you have direct finance on the bottom side, you have indirect finance up top, you got all the lenders, savers over here, you got all the borrowers over here. Direct finance tends to happen in the markets as opposed to the institutions. Indirect finance tends to happen with intermediaries or financial institutions. So in the marketplace, you'll have a borrower might issue a security like a stock or a bond. The lender buys it directly from them. There's a direct transfer from the lenders to the borrowers. In indirect finance, that would be, for example, like a depository institution like a commercial bank. So the lenders and savers deposit all their money in a checking account. The bank pools all that money together and then decides who to give that money out to. So that's the difference between direct finance and indirect finance, and that'll pretty much be how we split up markets and institutions. Markets tend to be more direct finance. Institutions tend to handle the indirect finance, where you pool money together. We'll kind of compare and contrast why you have those two different markets. There's certain types of financial transactions that are set up for one versus the other. But before we do that, let's go through and we're going to talk about different types of intermediaries, and then we're going to talk about different types of markets. All right, let's talk about types of financial intermediaries. We'll start with commercial banks or depository institutions. There's lots of bank-like entities like savings and loans, credit unions, and whatnot, but we all, for the most part, know what a commercial bank is. It's where you deposit your money. So banks were originally created just as a place to store your money. They were actually created by blacksmiths and goldsmiths who had a vault, and everybody would come and use their vault, put their precious metals and whatnot in it, and they'd get a piece of paper that said, you have so much in our vault, and then they could actually take that piece of paper and use it like money. That's kind of how money was created. It went from being precious metals, which nobody wanted to carry around all the time, to being pieces of paper which were promissory notes that said, I have a right to a certain amount of precious metal somewhere. So that's kind of what banks were created as. They've expanded a lot over the years to where now they have a large role in money creation in an economy. Banks create money whenever they make loans. Let's look actually just in a nutshell at a bank balance sheet. We're not going to spend a whole lot of time on this. This is for a different class, not really for this class. But in a nutshell, let's look at how banks kind of function. This is a bank balance sheet. This is the first balance sheet we've seen this semester. Next lecture is on financial statements, so we'll spend a lot of time on balance sheets, income statements, things like that. But for now, let's look at a real simple one. Assets equal liability plus equity. Hopefully you've seen that before in an accounting class. So these two sides of the balance sheet have to add up. Assets are everything the bank owns. Liabilities and equity is how they raised that money to buy this stuff. So deposits is the big thing on the liability and equity side. Capital just refers to equity at a bank. It's called regulatory capital. We don't call it equity, we call it capital. Every other balance sheet we call it equity. But deposits is the much bigger one, and that's everybody that's gone in and deposited their money at a bank. When you go in and deposit your money, that's a liability for the bank because they have to give it back to you. It's not their money. They basically borrowed it from you, and then they can take that money and go out and buy stuff with it. What they have is they have two main classes. Obviously a bank balance sheet is more complicated than this, but this is the big accounts. They have two main classes of assets. They have reserves, which is some of their deposits that they've kept on hand in their vault or kept it stored at a central bank or something. And then they have loans. Loans, they go out and they make mortgages, they make small business loans, things like that. Those are their money makers. Those loans they make, they receive interest on and they make money. Banks are called balance sheet driven in that they make money based off their balance sheet. They have assets that earn more interest than they pay on their liabilities. They pay very little on their deposits. They earn interest on their loans. They get to keep the difference, and that's how they make money. The way banks create money, real quickly, is they can artificially create deposits that don't really exist. Most deposits are in the form of checking accounts, not in the form of cash, dollar bills. They can't create dollar bills, but they can create checking accounts. If somebody walks in and says, I want a loan for $1,000 to buy some inventory for my business, what they'll probably do is just credit their account with $1,000. Deposits go up 1,000, loans go up 1,000, everything balances out, but now there's 1,000 more deposits out there. Deposits are part of the money supply, so the money supply goes up 1,000. So what ends up happening is, as the bank makes more loans, the money supply expands. As the bank contracts loans, the money supply contracts. So there's a link between the paper economy and the real economy in terms of when banks are expanding their balance sheet and making more loans, more economic activity happens, more jobs are created because more businesses are able to start, more houses are built because more mortgages are made. At the same time, the money supply expands, and then the opposite happens when they cut back on loans. And that's in a nutshell how banks work. If you want to know more, you need to take a class on money and banking or something like that. Okay, another type of intermediaries, insurance companies. Most of us know what insurance is. They help us manage our risks. So instead of, they're also a balance sheet driven business. So they actually act similar, again, to the way a bank works, which is you don't pay deposits to an insurance company like you put deposits in a bank, you pay premiums. So let's say, for example, life insurance. You pay your premiums ahead of time, obviously before you die, pass away. And then in the meantime, they get to take those premiums like a bank takes deposits, and then they get to go out and buy investments with them. Another type of intermediary is our funds, mutual funds, pension funds, hedge funds, things like that. They're pure middlemen, which is all they do is take a bunch of people's money, pool it together, and invest in something. So a mutual fund, for example, has no debt. It's all equity. Every time you buy into a mutual fund, your money is going into the pool of equity, and then that pool of equity is used to buy stocks and bonds or something like that. There's slight legal differences between, for example, like a mutual fund and a hedge fund, or there's pretty big legal differences. A hedge fund is not regulated very much at all by the SEC, whereas a mutual fund is very heavily regulated. Hedge funds, they're only available to what are called sophisticated investors, people who have a fair amount of wealth and make a fair amount each year. And they're considered to not need the protection of the government, whereas mutual funds are for anybody, but they have the protection of the government watching the mutual funds. So, and pension funds, are run by schools and companies and things like that who have employees. Schools actually run things called endowments, which are similar to a pension fund. They're all large amounts of money that have been set aside over time and pooled together, and they're invested in things. So it's just a middleman who invests on behalf of a whole bunch of people. We really don't need to get any more detailed than that. There's also things called real estate investment trusts, where what they do is pool a bunch of money together and buy real estate and earn rents off the real estate. Real estate finance is kind of its own field. There's classes on real estate finance, but it's one of what we call the 4 pillars of finance. There's commercial banking, which we've talked about, insurance we've talked about, real estate finance, and investment banking, which we'll talk about in a second. But real estate finance is just what they do is they buy real estate, own it, and earn rents on it. It's kind of like all the other intermediaries where they pool a bunch of money together, buy some asset, and then they're balance sheet driven, and that they earn more on their assets than they're paying out on their liabilities, and they make money on the difference. Okay. And then lastly, we'll talk about investment banks. Investment banks are a little different than the other intermediaries we talked about, in that they're not really what we'd call balance sheet driven. They're a service provider. They get paid based on the service they provide to their customers. Their customers are businesses. Businesses, when they want to raise money to start a new project, expand their business, whatever, they will go to their investment banker and say, can you raise $100 million for me or something? And it's the investment banker's job to go figure out how they can raise $100 million for them. That's what investment banks do. So most of the time to do that, they issue securities, stocks and bonds, things like that. And so it's an investment banker's job. Investment bankers get paid very well, but there's a good reason for it. They know everybody who has lots of money to spend. If you know a lot of people that have $10 million to spend, you could be an investment banker too, but most of us don't. But the investment bankers do. That's their job. If a business comes to them and says, we need to raise $100 million, they need to find out where they can go, call up a banker and say, do you have $10 million to buy some of these bonds? If it works, then they're a good investment banker and they get more business in the future. So that's what investment bankers do, is they issue new securities. And then they keep a small cut. They issue the securities for slightly more than they paid for them. Usually when an investment bank takes new securities to market, they do what's called an underwritten arrangement, which is they buy up the whole lot of securities first and the business gets their money immediately. And then it's the investment bank's job to go out and resell those securities. They can also do what's called a best efforts agreement, where they don't buy the whole lot, but that's not usually what happens. So in an underwritten arrangement, the investment bank gives the company all their money right up front, and then it's their job to sell those securities for slightly more than they paid from them. So they're not driven by a difference in assets and liabilities. They're driven by how well can they sell those securities. So they actually create the next thing we're going to talk about, which is marketplaces. They create securities that trade in marketplaces like stocks and bonds, which is a different type of finance. It's not really, it's not indirect finance, it's direct finance. Let's talk a little bit about what we call the IPO process. IPO process it's an initial public offering. And that's when a company issues stock for the very first time. When a company issues stock, they become what's called a public company, which is they're owned by the public. Whoever's owns some of their stock is technically an owner in the company. Prior to issuing that stock, they were privately held, had a limited number of owners. The IPO process works as business goes to their investment bank. They say, we want to go public. You usually don't go public unless you have a really big project to undertake, because you need to raise a whole lot of money, and going public allows you to do that because you sell shares to millions of people and you can bring a lot of money in all at once. What the investment bank does is they put together a syndicate of other investment banks who have brokerage arms that actually sell securities to individual investors, and they go out and they test the waters and figure out what the individual investors are willing to pay. They pool all that information together and figure out what price can we sell this security at. The price that the security sells at, the stock, determines the cost of capital for the firm. So they'd like to sell it for as expensive as possible to cheapen how much the firm's going to have to basically pay back in the future on that stock, interest-wise. I am running out of time on my 15 minutes, so we're going to switch over to a second video.